Thinker, writer, motivational speaker, and also happens to be the global managing director of McKinsey & Company. Dominic Barton is one of the most influential leaders in the world today, and I caught up with him over the weekend to understand some issues that we here on The Big Picture have been focusing for some time now. For instance, how can companies step up innovation at a time when the world economy is on tenterhooks and the uncertainties continue? Or what role private sector can play to reduce the alarming levels of inequality, as highlighted by the Oxfam report, which found that 1% people in the world own more than 99% of the people, their wealth put together. That is indeed alarming. Well, here's an excerpt of that conversation I had with him.
Dom, you've written extensively about the idea of long-term capitalism, how we need to think in the long term and not get caught up with the short-term returns. In the context of the complexities in the global economy that we just spoke about, is the idea of long-term capitalism gaining even more urgency and importance?
Yeah, I'm a huge believer that we need to have more long-term investors. We need to have more of a long-term mindset. My worry is that in the last 30 years we've become much more short-term. It's what I call quarterly capitalism. We're more focused on delivering quarterly results than thinking about investments that may take multiple quarters to be able to work. And with a capitalism that becomes more short-term and more narrow, it has a cost in terms of investments that we make, R&D, and actually even inequality, because when you're long-term, you actually care about the environment.
Right.
You actually care about the quality of your relationships with other stakeholders because you're thinking about long-term profits.
Because what's happening, like even globally, we're seeing like recently, even with some of the big investment banks like Goldman Sachs, the remuneration of the CEOs is now tied to how the stock price does. Do you think that is again a reflection of the issues that you are flagging?
It is. I mean, compensation is a factor that you have to look at, and I actually think there's been a change in investment banking to the positive, actually, because what a lot of banks are now doing, HSBC is one in particular, those CEOs get paid over time. So you may retire as a CEO, but you're still going to get your comp 5 to 8 years afterwards, which means you're, by definition, going to be very worried about what happens over the long term, not just within the quarter. So I think a lot of compensation committees have moved away. I think in the 2008, 2007 period, it was very much what I call eat what you kill, direct drive.
Right.
I think that one of the changes that's been in place is you got to make it more of a long-term comp program so that you get the benefit or the cost of how the organization performs over time, even after you've left your role. That's what I think we're seeing a shift to.
Right, but are you seeing that increasingly even among the manufacturing companies? Because the issue, as you rightly said, is that not enough R&D investment is being made. Companies want to hold back on their cash. Look at the return that their cash is generating. So they're not deploying the money in the way in which they should, and especially at a time when technology and innovation will perhaps be the key.
Well, I think there's a lot of pressure. It takes a very courageous CEO in a pharma company or in a, even if you're someone like, think about Andrew Liveris, he talks about this at Dow. He could easily jack up the stock price by cutting the R&D. He could probably get away with it for 3 years. He won't, because he believes in the long term. He believes in a 10-year view. But he gets a lot of pressure for that. And so it is a cost right now that with that short-term pressure, people are not investing as much. And there's academic research that actually shows that, some work. It's actually affecting even U.S. GDP growth by, by half a percentage point because we're not doing it. We've done our own surveys which show that, there's about 75% of CFOs that will not make net present value positive investments if it means missing their quarterly earnings by several cents. So you want to do that because it's important, but you're very worried about being hammered by the market.
A lot of research has also shown, Dom, the fact that the reason why the short-term thinking is also because the results of your decisions in short-term is more visible, whereas the results of your decisions in the long-term becomes all that more blurry.
That's true.
So how do you reconcile the fact that there is a fundamental tension?
No, there is, and you need to do both. I mean, I don't, if someone was just say to me, well, just look at my long-term returns, and you go back to the Keynes comment, we're all dead in the long run. I mean, you need both. You have to have short-term and long-term. My worry right now is we have way too much short-term. It's like having it's stereo, right? We've got a long-term speaker and a short-term. What's been happening in the last 30 years is this one's been just shut down, and all we're hearing is this screaming. We need a balance.
Right.
That's the issue. So I actually believe companies should report numbers on a quarterly basis, even if I believe in long term. I don't think we should be giving guidance every quarter. I mean, how, you know, the world changes. What you don't fundamentally change your business, even in a tech company that's moving quickly. You know, you need to have long-term thinking in that. And we've seen it with Facebook. I mean, I think the reason Facebook was able to transition from a PC-based to mobile-based platform in the middle of their IPO is because they had a controlling long-term investor, Mark Zuckerberg.
Right, right. Tell me also a little bit what you think about the role of the private sector in social development, because you know, this issue gains urgency in a context of India where government resources are limited, and the private sector has to play a big role to bridge that resource deficit. And also at a time when many would say that the private sector is going through perhaps its worst time in terms of its image. Its image has taken a huge beating. What can it do?
That's true. I mean, I do think the trust in business globally has been dropping, and that's I worry about that. I think there's a very important role for business to play in society. It goes back to actually Adam Smith, you know, in his first book, which is called The Theory of Moral Sentiments, Before the Wealth of Nations. He said, it's the duty of the entrepreneur to take care of the society in which you operate. That's a pretty socialist type thing for old Adam Smith to have said. But what it means is, you know, there's not a trade-off between shareholder value and stakeholder value. The two go together. If you aren't trusted, if you're not contributing to society in a way, building, educating, training people, helping with the infrastructure, playing a role in ensuring that the environment that you're operating in is better, you won't have the trust and you won't have the return. So they're very much together. And I actually think there's many Indian companies that do that. The reason I wrote the article I did in the Harvard Business Review about 5 years ago is because when I moved from Asia to London and spending time in the more Anglo-Saxon world, I noticed the big difference.
Absolutely, yeah, you mentioned.
And there were Indian companies. I remember, you know, KV Kamath at ICICI. You talked to him. It was in his bones. He wasn't doing it for corporate social responsibility. He knew he had to figure out, if he's going to be able to be a successful institution, how to do rural banking. It wasn't just about inclusiveness. It was about long-term success. And I think I look at a number of the Indian CEOs who are involved in education, involved in country building.
Perhaps in terms of percentages, perhaps more?
I think it's more, but I think we need more. Everyone has to play a role, or you don't have legitimacy.
Right. Finally, Dom, we saw the Oxfam report on inequality that came out. Sort of purposely, it was released to coincide with the Davos summit. Your views on that? Have inequality levels actually reached a point where something really and urgently needs to be done about it?
Yeah, I'm actually quite worried about rising inequality. I mean, you know, many people will say that, okay, across countries, you know, we've never seen such a decrease in inequality globally because of the poor that have moved into the middle class. And that may be true, but the worrying thing in my view is this in-country inequality is getting worse. And that's a worry. I think the Oxfam number was something like the top 1%.
Or more than 99% put together.
It's staggering. And what I worry most particularly about is the inequality of opportunity. I think we're always going to have inequality in a capitalist system, and I'll defend that because that's part of, you work hard, it's innovation. But if it's inequality of opportunity, that is a fundamental problem. And I do think that's getting worse. And it's getting worse in many, many countries, including China. Even though the overall level's up, it's getting worse. And that, when you do that, you fracture trust. And one thing we don't talk enough about in terms of economic development is social capital.
That's right.
A lot of GDP growth at the fundamental level is you need social trust. Trust in institutions, trust that, yes, if I play by the rules, I can have a chance to be able to make it forward. If all of a sudden that's not there, you get distrust, you get breakdown, and you ultimately get revolution.
Right. Thank you for that conversation, Dom. Pleasure to have you. Thank you for your time.
Again.
Thank you so much.
Thank you.
Well, there you have it. That